I'm Ed Rimmer, Chief Executive of Time Finance. I've been involved with lending to SMEs for over 25 years now. A good chunk of my time was spent with Bibby Financial Services, one of the leading independent providers in the market. I originally joined Time Finance back in 2007, had some time away from the business during lockdown, and then rejoined as Chief Exec in June 2021. And put together a 4-year plan, which we're now coming to the end of the 3rd year of. So happy to take you through where we're at during the presentation. James, do you want to just give an introduction?
Yeah, thanks, Ed, and good afternoon, everybody. I'm James Roberts. I'm the CFO of Time Finance. My background is over 20 years in financial services, of which the past decade or so has been in lending. And I've been with Time Finance now in the CFO role for coming up to 7 years, just under 7 years at the moment.
Thanks, James. So if we just move on to the next slide after that one. Great. So just before we get into an update on the strategy, James will then go into the numbers. So just before we get into the main body of the presentation, for the benefit of those shareholders, for the benefit of those people who are on the call who don't already know about Time Finance, it's worth just giving you an introduction of who we are and what we do. I won't spend too long on this, but effectively we are what is now known as an alternative finance provider. So that means we're a non-bank independent lender. Our job is to go and source cash as cheap as possible and lend it out with a margin to small businesses, typically who turn over up to around £10 million. We support around 10,000 of those SMEs across the UK. We lend predominantly off our own balance sheet, but we do still have the flexibility to broker on deals if we choose to. That is typically within our vendor finance division of the asset finance part of the business. And importantly, we are a multi-product provider. So we provide more than just one offering through assets, invoice, and commercial loans, as well as a combination of those products through an asset-based lending solution. Next slide, please. The core products are asset finance and invoice finance. There's some similarities between the two in the sense that they are both sourced through introductory channels, which are intermediaries. So typically finance brokers, insolvency practitioners, professional consultancies. We also have some vendor supplier relationships in the asset finance division. And as I said earlier, typically both products are targeted towards small businesses who typically turn over up to £10 million. We will go and fund new start businesses from time to time. Typically, as I say, they are the smaller end of the market. So if we look at asset finance, that is for businesses who are buying new pieces of capital equipment or indeed refinancing existing kit off a balance sheet. It's for soft and hard assets. So soft assets typically won't have a residual value at the end of the lease. Hard assets typically will. Deal sizes, as I said, anything up from £1,000 to £1 million is the top end of where we fund in the asset finance division. Our sweet spot for soft asset is typically up to 20k, and for hard asset is around 50 to 100. And we yield between 9 at the very low end of our hard asset bigger deals to 19% the smaller soft asset deals. And our funding comes from a range of wholesale block funders and also the British Business Bank, who fund the majority of our hard asset business. Invoice finance is for cash flow finance as a direct alternative to a bank overdraft. The facilities are historically known as factoring and invoice discounting, now generically known as more invoice finance, and that could be disclosed or confidential. Deal sizes are slightly bigger, so we'll go up to 3.5 million as a maximum size. And our sweet spot is typically from 250 up to £1 million. That's where we like to fund the majority of our business. The yields are quite similar. The bigger the deal, the better the quality of the deal, the lower the yield, 10%. And then the smaller slightly more tier 2 deals, 20% is the return on those. And our funding comes from corporate banker back-to-back facility, and that is through NatWest, which is a long-standing relationship that we have with them. James will talk about the funding in a little bit more detail during his section. Next slide. So how we stand out from the crowd. So at one end, you've got the banks. We don't tend to compete head on with the banks. The banks typically will decide to fund alternative finance providers like ourselves, and that's their way of contributing to SME funding. That's really the model now that they have deployed. We also have challenger banks in the market, alternative finance platforms, otherwise known as fintech businesses, and a smaller bunch of quoted companies like ourselves, but not that many that do what we do. And then at the other end, the smaller private businesses, of which there's a multitude of them, typically smaller and more regional players. Now, those businesses will compete head on with us in terms of flexibility, speed of response, and a personal approach, but they typically will be a one product provider. Whereas at the other end, the banks will have the multi-product offering, but they typically will not be associated with the things that small businesses now need: flexibility, speed of response, personal approach. And we like to think that we're in a smaller bunch of competitors who have both those aspects. So we have got the multi-products offering, and we have got the ethos of the smaller private business, and very much focused around service, flexibility, and that personal approach that small businesses need. So that's where we play in the market. Next slide, please. And we've also won some awards, testimony to the hard work that's gone in to the last 2 or 3 years by our 147 staff that we're up to now. We've been nominated, shortlisted, and thankfully we've won some awards as well. Next slide. And if we just go one more, thank you. So in terms of the plan I referred to in the introduction, this was put in place in June 21 when I came back into the business as chief exec, and when we were coming out of COVID. And we put in place 4 key strands. And this was very much on the back of things starting to get going again in terms of lending to SMEs post all the government funding. And I should say it was immediately post us having done a rebrand of the business. So the business was previously called 1PM PLC. And at the end of 2020, during COVID, it rebranded to Time Finance. So the first objective was to become a nationally recognised SME funder. And that was not saying that we were going to become a household name. It was very much targeted to our key introducer market, the brokers, and making sure that post 1PM, people understood who Time Finance was, what our offerings were, and the business that we wanted to do, where we sat in the market. So that was the first objective we set ourselves on the back of the rebrand. The second was to more than double our gross lending book from the starting point, which was 115 million in June 21. The third was to get the business back up to achieving run rate profits from organic growth in excess of where we were pre-COVID. And the final one was to very much focus on balance sheet lending, and that was on the back of having previously had more bias towards broking on than we do now versus own book. And I'll come on to where we are in the results. Next slide, please. So I think sort of nearly 3 years in, so 3/4 of the way through our third year of the plan, we're really pleased with the progress we've made. The 2 key lines there underneath the big bubbles you'll see are the growth since the launch of the strategy, so going back to June 21, and then the growth since the start of our financial year, which was the 1st of June 23. And you can see there the gross lending book is now up to 190 million. Significant growth since the start of the plan from just over 115, 64%, and that growth has continued since the start of the financial year. And that's very much been driven by our 2 core products: the hard asset element of our invoice finance division, and invoice finance. So between those two divisions now, it makes up just under 75% of our overall lending. And you can see the significant growth we've had in those two offerings. Hard assets has more than doubled from 32 million up to the 80 million since the start of the plan. And invoice finance, similar growth from 25 million up to 60 million. So significant growth from those two offerings, and that's been very much deliberate around those two products offering secured lending predominantly against the assets that we fund. Next slide, please. Just some other key metrics to highlight. The unearned income, so the amount of income that we lock into our book, that 190 million, when we do new loans and leases, is currently sat at 24.6 million, and that's an increase from 14.3 at the start of the plan. And why is that important? Well, it gives us forward visibility on the income that's going to drop into our future P&L from the deals that we've done. So great growth since the start of the plan, and that's continued since the start of the financial year. I mentioned just a minute ago in terms of the broked on versus own book. You can see when we started the plan, it was 87-13. If we go back in time even further, it was more 75-25. So the bias towards own book lending and building that balance sheet really is striking as we stand now, because it's now 98-2. So very little is broked on. We do still have that opportunity, and that is focused within the vendor finance part of our business, where the deal size, whether it be too big, or the rate, whether it be too fine, or the credit, whether it be too good, which drives a lower rate, or not good enough, that's where we broke on a small amount of business. And the final point, which is really important, James will talk about this in a bit more detail in terms of the trends, that's the net arrears. Thankfully, that has reduced. That is one positive of a downward arrow on the chart, from around 13% when we started the plan down to 6%, and it's been flat this year as the book has grown. So we're pleased with the balance of the quality of business we're taking on at the moment. Next slide, please. So this is the final slide before I hand over to James, just in terms of the progress that we've made. So just in terms of those key strategic objectives, some key updates. The focus on the core business is now really complete. We did have 7 offices and 7 or 8 businesses in the old 1PM business. We've now rationalized that, and we have 4 trading offices, 2 in asset finance in Bath and Warrington, and 2 for invoice finance, 1 in the north in Manchester and 1 in the south in Reading. We exited the last of the non-core businesses back in October 22, and that was the consumer finance brokerages. And we exited the small unsecured loan market in December 22 to focus very much on the secured elements of loans. And that was very much consistent with our strategy. We've brought in some new people. You can see there, we've made some key appointments. We brought in a new director of the risk division. Steve Nichols joined a couple of years ago, and he's made a great impact in taking that business forward, particularly the hard asset side. You'll recall the growth in that division, and that's where Steve's experience lies. We brought in a new head of credit in July 22, and he's enabled us to get to some bigger, more challenging deals that need more structure and more experience in terms of putting those out to the brokers to get them over the line. Sorry, thank you. And we brought in a new head of operations as well, who spearheaded the move into the asset-based lending market and that product in terms of putting that together, and also taking in some operational efficiency improvements, which is very much part of the future plan of our business. We've continued to develop our product offering. I mentioned the ABL launch last April, and also the elements of the soft asset that is arguably slightly outside of the drive towards hard asset and invoice finance. That's the original Bath-based business. We are still very much committed to that offering. It's typically deals that are less than £15,000. They typically yield the higher end of the range that I mentioned earlier, around 18 to 19%. We have some good loyal brokers that have dealt with the business for a long time, and what we've put in place is a fast track operation. So there's quite a number of smaller deals, but they're now fast tracked through the pipeline so that we can make ourselves more efficient and make those deals more profitable for us. So that's the elements of the original 1PM business that we still do have in Bath. And we've continued to build our brand. We sponsored the National Association of Commercial Finance Brokers the last 2 years, 23 and 24. As I mentioned earlier, we've thankfully won some awards, which all helps with our brand building, our recognition. And one of those was being ranked as the #1 in Business Money in terms of the intermediary index, which we didn't previously feature in on the 1PM days. So that was a real high for us. So that's a summary of where we've got to in terms of our plan and some of the notable achievements we've made. I'll come on after James just to give a summary of where we are and where we're going in terms of the next year or so. So I'll hand over to James at this point.
Thanks, Ed. Appreciated. If we could skip on a couple of slides, that'd be fantastic. Yeah, I'll just do a very quick whistle-stop tour through the numbers, conscious of time, and hopefully open it up to questions after that. But so this morning we released our Q3 trading update. So these numbers are effectively hot off the press, and it was a third quarter that we were very pleased with in terms of the numbers. Everything, as Ed alluded to, going to plan. I'll start with a graphic here of the lending book, because as one of Ed's 4 key pillars that he mentioned earlier, it really is absolutely crucial to driving our revenue and in turn profit. The bigger the book, if you get the right quality of deals on it, that will lead to increased revenues over the length of the lease or the loan or the relationship in IF, leading to revenue coming in every month for 3 months, 6 months, 9 months, a year, 2 years, all the way through to 5 years, depending on the length of those things. And if you get the quality right, which is about the arrears and write-offs, which again Ed alluded to, which are key, that will drive the profit as well. So if the book is growing and the right quality of deals are put on, that will lead through to future growth. So this is absolutely key. And what you can see here is on the left-hand side, back in June 21, when we set the 4-year plan, the book was about 115 million, and it's grown quarter on quarter, a few monthly plateaus and dips, but overall quarter on quarter, it has grown for 11 now consecutive quarters to about 190 million at the end of February, at the end of our third quarter. So 190 million, all-time record high. That's also well ahead of the levels pre-COVID, which were about 140 million. And as you can see, as I say, a few ups and downs, but overall continual growth month on month throughout, which is really pleasing to see. And that's driven, if we can flip on to the next slide, that's driven the numbers that we'll see here, which, as I say, were published this morning. And crucially, on the right-hand side is a lot of ticks. And some nice growth in all the key metrics. These are the key financial metrics we look to run the business by, and I'll quickly run through all of those. Own book origination. So this is new deals we've done, and then we've written them on our book. So these have led to the increase in the book. It's the lifeblood of the business. If this number is going up, you can expect the book to go up, which I alluded to, will then lead to revenue going up. And as long as there aren't lots of write-offs, it will lead to profit going up. So this is the first indicator of future profits. Own book origination for the 9 months to the end of February 24, up 13 million or so, or 25% on the 9 months to February 23. So the hopper, the front end, 25% growth year on year, which is great. And that has led to this own book lending growth, 190 million, as I touched on, which is 21% up on the year before. At February 23 was about 157 million. So growth of 33 million or so over the 12 months. Ed touched on the unearned income, also up in the mid-20s, 27% up to 24.6 million. And this, as Ed said, gives us good future visibility of income. And we can see what will drop in over the coming months and years of the leases and the loans. Arguably, it's easy to lend money. He says somewhat facetiously, the skill is in getting the money back in. And so arrears is quite a key figure for us. It's worth me stressing this isn't write-offs, and the arrears don't necessarily lead to write-offs at all. It's just an early warning indicator of deals that potentially aren't working quite to plan. And that's anything from they've missed one direct debit, they're a day down, and our credit teams may call them up and get them back online the next day, all the way from one day down through to they're in the legal process and looking to recover our money that way. But crucially, we've grown the book significantly, 21% year on year, but arrears as a percentage of the book have stayed the same, which implies the quality of the book is the same. We're not putting on weaker credits on our book. We're putting on similar standard book. We're just growing it in the same makeup it's been before. So really pleasing to see those numbers holding firm, especially given some of the news we hear in the news about macroeconomic headwinds, etc. We're certainly bucking that trend, we think. Our balance sheet, another one of the key pillars was to strengthen our balance sheet, and our consolidated net tangible assets continue to grow. They're at 37.6 million now at the end of February. That's 14% up, or 4.6 million up on the year before, where they were 33 million. And crucially, all of this has fed through into what we think is a pretty solid P&L for the 9 months. 24 million revenue, up 20%, and 40% increase in profit for those 9 months. 4.2 million versus 3 months for the 9 months the year before. And another little aside is that 4.2 million is the same as a full 12 months of profit we made the year before. So we've hit the previous year's profit after 9 months. So really pleased with that. That's a great increase in profit during the year, and long may it continue. We could skip forward. That'd be great. Thanks. Obviously, as an own book lender, our balance sheet is absolutely key, and we think we've got a pretty robust and solid balance sheet. We say there it weathers all storms. As you can see on the left-hand side, our net tangible assets have grown from 28 million or so back in May 21 to now just under 38 million or so. We've been profitable every single month, and that includes COVID as well. Whatever's been thrown at us, we've remained profitable, and we're profitable every single month. So that 37.6 million will continue to chunk up every month for the remainder of this financial year to the end of May, and long into the future, hopefully. So 37.6 million net tangible assets. And the other point I alluded to was the arrears. As I said, this is quite key as an early warning indicator of the quality of the book and what's happening out there in the market. 3 graphics here. The purple graph shows the arrears rate for the entire group. The the green dotted one shows the hard asset, one of our 2 key growth areas, arrears rates, and the blue dashed one is the invoice finance, the other one of our key growth areas. So you've got the total group and the 2 key growth areas there. And what you can see is as we came out of COVID, the arrears in all 3 have fallen from around about 12-13% for the overall group. And then since sort of the middle of 22, they've plateaued. The book has grown significantly, as I mentioned, but the arrears as a percentage have plateaued, which shows the quality of the book has stayed the same. So you can see the overall group arrears of around about 6% now for 18 months, getting on for 2 years. Hard asset bobbling around about the 4%-ish mark, and invoice finance about 2%. So arrears very, very static despite the growth, despite the news we hear out there about the economy, which shows that the UK SMEs we're dealing with are pretty resilient. And as I say, arrears of 6% we're very comfortable with in the areas we operate in. So that's particularly pleasing. And then the final slide from me before I hand back to Ed to wrap things up is, obviously, we can only do what we do thanks to having funding that sit behind us. We lend money, so we need to get money from other funders ourselves. This is just a quick snapshot of who our funding partners are. And you can see at the end of February, we had active facilities of about 160 million, of which we'd only used just over 120 million. So nearly 40 million of headroom there. And a lot of these are in the process of being renegotiated and renewed, which will increase our headroom for the foreseeable future further again. But we've got plenty of headroom at the end of February to keep going. And we've got a number of long-term supportive diversified funding partners. It's crucial for us to have a diversified funding base. We don't want to jump into bed with just one funding partner because you never know quite how that relationship will transpire. We've got a number here that we've been working with for a number of years, names such as the British Business Bank, RBSIF, Aldermore, etc., NatWest, Siemens, and others. So really supportive long-term funding partners, a lot of headroom to fuel growth going forward. And we were very pleased with the numbers we put out today. We think it shows we're on the right track and moving in the right direction at a rate of knots. And with that, I'll hand back to Ed.
Thanks, James. Next slide, thank you. And then the one after. Great. So just in terms of a summary to what we've said, the focus on our current strategy will continue very much on the basis of business to business lending now, own book, hard asset and invoice finance are the focus for the foreseeable future. So the medium term aims remain the same, and we believe that positive momentum is being carried forward towards year end and into the new financial year beginning on the 1st of June. The key hires that we've taken on into the business are now well embedded and making a difference, and our future is very much about growth, but tinged with improving efficiencies. Our profile and our brand recognition is increasing, and we're pleased now with where that sits in the introducer market, typically within our core brokers. The lending book continues to grow quarter on quarter, as James has taken you through in terms of the numbers and the graphs, and arrears are remaining well controlled. And thankfully, all that is played out in terms of the financial performance, which has been very positive. There's been 5 profit upgrades in the last 18 months. And as James mentioned, the most recent one was to 5.7 million on the 5th of March. So in terms of our outlook, as we move into the final year of our current 4-year plan, we still see significant further growth opportunities for the business, and that filtering into our bottom line in terms of profit before tax increasing. The compounding nature of the lending book, as long as we keep growing the book, as James mentioned, with the right quality, that should continue to increase. As should the net tangible assets. They now stand at over 37.6 million at the end of February and are growing month on month with the retained profits that we're keeping in the business. The market, thankfully, has taken note of our progress, and there's been a significant increase in the share price, around 70% in the last year, and that's against a much flatter AIM index. And I think the key point to leave everyone with is the market conditions. And clearly, there's a lot of challenges out there for SMEs. Increase in interest rates, although they seem to have stabilized now. Increasing costs, again, not going up as much, but still challenges out there for many small businesses. And that's really where we tend to come into play much more than mundane conditions. So we typically do well in times of boom and bust, businesses needing to access cash to grow, needing to access cash to survive. Our purpose is very much around that, providing cash for businesses to thrive and survive. So as long as we get the mix right between the business that we take on and the credit quality, and then we have an efficient business to process it through, manage the bad debts well, we will continue to do well and grow the business. So cautiously optimistic about the future, and I think it's a reasonable good time for alternative financiers with our structure and our people to do well. So that concludes our presentation. Happy to open it up to any questions.
Thanks very much, Ed and James. That was a very interesting presentation, and well done on the progress you've achieved to date. I'll just remind people, if anyone would like to ask a question, just click the Q&A button, which you should find towards the bottom of your screen, and you can type your question in there. So we have one to begin with from Adrian, who's asking, would there be any advantages in diversifying your funding base further by taking retail deposits? Presumably that would mean obtaining a banking license.
Yeah, I mean, I'll give my view on that, and then James, I'm sure, will contribute as well. It's something that we have talked about a number of times. It's something that I've experienced in previous lives, and clearly there's advantages to accessing retail deposits in terms of the margin that you borrow money at, and obviously your own margin that you can then charge on at. However, it's not something that we're intending on doing for the foreseeable future. It's a very, very in-depth, complicated and expensive process to go down. And we believe that we've still got a number of funding rounds that we can do with our with our debt providers before we get anywhere near maxed out with them. And it's a better model to deploy. We need to keep as little bureaucracy, regulation, compliance within the business as we can to remain agile and flexible and be able to act quickly. And that's the key to our proposition. James, I don't know whether you want to add to that.
No, not much, Ed. That's pretty much exactly what I'd have said. It's certainly one that's on the radar, but in the medium to long term, and not in the foreseeable future. We think we're pretty well funded. It's very diversified, and without going down that banking route, license route, I don't think there's much better funding we can get out there than we already have. We have
done 2 funding reviews over the last 18 months using an independent party, and just to challenge ourselves around the facilities that we've got, the quantum, the covenants, and the cost. And I think that backs up what James has just said.
Thanks. Yeah. So the bottom line is really that the scale you're at the moment, you can't justify the overheads and bureaucracy that taking retail deposits would involve, but it might be something for the further distant future, maybe. Thank you. Okay, whilst we're waiting to see whether there are any more questions from the audience, I've got a few that I'd like to ask. Firstly, what do you see as the principal constraints to your growth?
Yeah, well, I would say there's typically 3 constraints. Funding is the key constraint. People is the second, and bad debts. They're the 3 key constraints. And funding, clearly that's our raw material. So very much following on from what we've just talked about, we need to make sure that we access the right quantum, the right cost, and the right covenants of which we can then manage the business as we see fit. The people, we're absolutely a people-based business. Our audience, SMEs, value the fact that we're a people-based business, and they need the flexibility that comes with talking to people, explaining how their business works, and having people understand that. So having the right people in our business to both source the business at the front end, manage the collections at the back end, and everything else in between that is important. And if we don't get the right people, then it's very difficult to grow the business. And then the final one is bad debts. I mean, it goes without saying that we need to manage the bad debts. We do have bad debts. That's just a
life
aspect of running a funding business to small businesses. The key is to make sure that we're well spread. So that is a number 1 priority for us. We don't bet the ranch on any massive concentrated deal or sector that we lend into. We're very well spread, and we make sure that we get the right return for the right risk that we take on board. So I would say that they're the 3 constraining factors of growing the business.
Thanks, Ed. It's interesting. Adrian has another question. Given the CMA interest in commission payments in the car finance sector, do you perceive any regulatory risk of that nature in the markets in which you are involved?
Well, I'll hand that one over to James, because that's something that has been very topical for the compliance team, and James's oversight of that. So,
thanks for that one, Ed. Very, very good question. And firstly, to say we have the motor finance thing. We've been thoroughly through our book and have extremely limited exposure, if anything at all. We're talking in £10,000 or something. So no real exposure there in that thing. It's an area we don't really deal with anymore. We used to in the past, but it's long gone. In terms of, I suppose, mission creep or regulatory creep, there's always a risk, isn't there, that things can extend. The FCA does often put its fingers into new areas. There's no indication really we see or the industry bodies see and things like that it's coming into asset finance or any area like that. It's an area we watch, and we keep a watching brief and up to date on it. We think we run the business very well from a compliance side. We disclose all our commissions, etc., etc. So we don't think it's anything that's on the horizon in the short to medium term at all, if at all. And if it does come our way, then we think we're pretty well prepared anyway in what we do and the processes and controls we have in place. So we'll keep watching the space and see what happens, but it's not something that we think is a short-term risk in any shape or form.
Thanks, James. Yeah, I mean, presumably as a B2B lender, you're not quite so vulnerable to FCA concerns as if you were lending to consumers, which is their principal focus.
Absolutely. And as Ed said earlier, we exited all the consumer businesses a number of years ago now. And so it would be significant mission creep. It's not to say it couldn't possibly happen, but it would be significant mission creep from the FCA if they came into the unregulated business to business area, which is where we operate now.
Thanks. Okay. Again, whilst we're waiting to see whether any other delegates have any questions, I've got a few more of my own. According to Stockopedia, the return on equity that you generate is 6.3%. Does that sound about right? And if so, it seems quite low. Thoughts on that?
I think one of the sorry, Ed, I've jumped in there on it's a numbers question.
Yeah, you go for it.
Well, I think that there's two things. I think what Stockopedia might be doing there is looking at our tangible assets in working out the return on equity, and we've got significant goodwill in our balance sheet from previous buy and build program between 2015 and 2018. We, rightly or wrongly, we don't really look at that. We look at net tangible assets, and so our tangible assets are nearly 30 million pounds bigger than our net tangible assets, which are 37 million pounds. So it makes an absolutely material difference whether you go off net tangible assets, which is what we do and we think you should, or whether you go off just the tangible assets, which does include, you know, the high 20s, 27, I think it is 27 or 28 million of goodwill. So I think that artificially depresses it if you go off the tangible.
That's a very good point and makes perfect sense. Yes, I was just looking at your balance sheet, and as you say, there's 27 million of goodwill in there, which it does make sense to strip out from equity. Good. Okay. And then also something I was looking at your balance sheet, and what surprised me a little was that the financial liabilities were quite low. Is that because your financing is actually in the trade and other payables section rather than as financial liabilities?
Yes, absolutely. You're quite right. There's our funding lines, or the amount we've drawn, sorry, on the funding lines are within trade payables. So funding liabilities are very small, as you say, odds and sods of other things. The big one, I think, is 70-80 million or so is in trade payables, and that's where it sits.
Right. Okay. Thanks. And then finally, from me, you don't currently pay a dividend. Are there any plans to at some point in the future?
So I don't mind taking that one, Mark. So again, a topical discussion we have fairly regularly at the board, and something that I've answered on similar platform discussions. And the simple answer to that is that we have no current plans to pay a dividend, and that's because we see this very much as a growth stock. And our job is to make sure that we maximize the use of our cash in growing the business. And if we did pay a dividend, it would be very small, almost immaterial, particularly in the higher interest rate environment that we're in now, from when we did pay a dividend pre-COVID, which itself was very small, but that was in a different interest rate regime. And we just don't think that it's the right thing to do for this size of business when we're on a growth strategy. So that's the decision that we took prior to Christmas at the last board discussion. We'll revisit it again sometime this year, but that's the current view, and that's a supportive view of a number of our shareholders that have commented on that strategy as well. So
yes, I mean, as you say, when you're primarily financing your lending from your own balance sheet, building up the balance sheet, I guess, is the priority.
Yeah, and that's where we see return coming from the stock is through capital growth.
Great. Okay, well, as there aren't any further questions from the audience, I'll say thank you very much. It was a very interesting presentation, and thanks for your time in answering the questions too.
Thank you.